Good evening. This is Mottek on Money. We're doing it live right here, weeknights in the 5 o'clock hour here in Los Angeles. Mottek on Money, 5 nights a week for you, live on the air here in 790 KBC, streaming live online worldwide at kbc.com, and the on-demand Mottek on Money podcast for you at kbc.com, Apple, iTunes, all your favorite podcast platforms, and on the socials too at Frank Mottek on X, formerly known as Twitter and Instagram. Hope everyone made it through the hurricane weekend. Tropical storm Hillary raking Southern California with lots of rain. We'll talk about that coming up later this hour with the one and only Dallas Raines, famous meteorologist on ABC 7 Eyewitness News. Dallas Raines will be joining me live later this hour. On Wall Street, meanwhile, the S&P 500 and NASDAQ finished with their first gains of the past 5 trading sessions today. It looks like a bit of a breather, and the summer sell-off here today, despite another big surge in benchmark government bond yields, the ones that impact the fixed-rate mortgage rates, among other things. Also concerns about China's economy, which perked up again last week. We're seeing the yield on the 10-year note at 4.34%, the highest we've seen since November of 2007, preceding the financial crisis. Interesting move there. Rising yields have been a problem for some of the big tech names already. Stocks have moved lower. The tech stocks historically have been very interest sensitive, and of course they've been leading the market lately and leading it lower most recently. We did see the Dow moving lower today. Johnson & Johnson among the decliners, among the Dow 30 stocks, finished down by about 3% after the company announced its $35 billion exchange offer for Kenvue that expired last Friday was substantially oversubscribed, and shares of Dow component Goldman Sachs closed down by nearly 1%. Taking a look at some of the other action here, we see shares of Palo Alto Networks getting a pop today, up about 15% after the cybersecurity company's report of earnings results topped analysts' expectations, and so did its forecast for profit and billings. Tesla rebounding today by about 7% after an analyst at Baird highlighted positive developments for Tesla in the second half. Nikola, another EV maker, down by about 23%. That's the electric truck maker. It said they plan to offer about $325 million in senior convertible bonds. And Nikola also updated recent voluntary recall of more than 200 of its electric vehicles after investigating their battery packs. And one of the meme stocks back in the news, AMC Entertainment Holdings, down by about 24% ahead of the company's planned stock conversion. The conversion of AMC preferred equity units will result in the trading of a single AMC common share class. AMC also planning a reverse 1-for-10 split of its common stock and an increase in its authorized common shares. Damage assessment continuing here in Southern California among many businesses and residents following the first tropical storm the area has seen in 84 years. The remnants of Hurricane Hillary, which barreled up the Baja California coastline over the weekend, walloped the Los Angeles area with heavy rains and high winds. I'll be discussing that epic weather event that we just experienced with ABC 7 Eyewitness News meteorologist Dallas Raines, who's on Channel 7 right now. He'll be joining us later this hour. He's been following the weather in L.A. since 1984. Dallas Raines will be joining us live right here later this hour. Another fiscal cliff, meanwhile, approaching in Washington. Stormy times there again. Nervous time over the interest rates, too, and the Fed's next move as inflation ticks higher. On the economy tonight, I'll speak with Paul WINFREE, President and CEO of the Economic Policy Innovation Center, EPIC for America, a new economic think tank, former economic policy advisor and former White House Director of Budget Policy under President Trump. He'll be joining me live later this hour as well. But first, on your money, the markets, the economy, joining us live now, Jonathan HOENIG, Fox News contributor, portfolio manager at Capitalist Big Hedge Fund, and author of the book Price is Primary, How to Profit with Any Asset in Any Market at Any Time. He's also big on Twitter, too, and thanks for the follow there, Jonathan. We do appreciate it, and a lot to follow with the markets here today to kick off the new week after a rough week last week with those bond yields soaring. Give us your assessment of things here at the moment.
Yeah, Frank, great to be with you. I'm thinking of you with the weather in Southern California, the storms approaching, the storms there, and watching, as you said, I mean, look, some of the storms on Wall Street, both in the stock market and in the bond market. I mean, Frank, look at the yield on the 10-year notes up near 17-year highs. Look at some of the price performance and some of the fixed income instruments. I mean, TLT, Frank, that is the long-term Treasury ETF. It's down by about 17% over just the last year. So people are losing their shirts, not just in stocks, but in fixed income once again. And that bodes pretty poorly for risk assets across the board.
That is pretty amazing. And right, we haven't seen the yields at these levels since, 2007, which, of course, we have to go back to the history books now. But that preceded the financial crisis. It was kind of at that time, I remember somebody stood up at one of the financial forums and said, we're in the middle of it, whatever it is we're in the middle of. And a lot of people didn't expect the Great Recession, but boom, there it was. So what is the bond market telling us at this point?
Well, I mean, look at underneath the hood. You said, Frank, look, most of the indices did bounce back today, but you still got only 50 new 52-week highs and over 350 new 52-week lows. So the trend for stocks really is very much down. The majority of stocks now are trading below both their 200-day and their 50-day moving average. And some of the weakest names are those particularly sensitive to higher interest rates, both utilities, for example, and REITs, those real estate investment trusts, new 52-week lows across the board there. So I just think, Frank, for those of us in the risk game, it's telling you, as Jesse Livermore would say, there's a time to go long and a time to go fishing. I think now is one of those times to go fishing and be on guard because, if 2023 is if 2022 is an indicator of 2023, higher interest rates are what precipitated that massive sell-off in stocks last year, and it looks like it could repeat for us once again here in 2023. On
the air live with Jonathan Hoenig. So we see gold hovering at just above $1,900. Oil is still hovering around $81 a barrel. Inflation still a big worry. In fact, ticking higher, according to the last reading we got. What about inflation and the Fed's next move and these commodity prices here?
Yeah, I mean, I think inflation is is still with us, Frank. In fact, it's rearing its ugly head once again. In fact, if history is any guide, you'll recall that back in the towards the latter half of Ford's term, the expectation in the 70s was that in fact inflation had been licked. Of course, it more than doubled back in Carter's term, even into Reagan's term many years later. So, I don't think inflation is back in the bottle at all. In fact, some of the only places I think you can put money right now are in those inflation-related names. In fact, one area I'm looking at now, Frank, is an ETF, which is FTSL. These are some of these senior and floating rate linked ETFs. You're wanting to be finding places that basically can do well even if interest rates go up. So even rates, that's RATE, that's a pretty unusual ETF. It actually goes up when interest rates go up. So I think this is really a headline story that's not going away anytime soon. And just look at some of the performance, Frank, this August of some of those big cap tech stocks. Apple's down 11%. Tesla's down 20%. Microsoft and Meta are both down anywhere between 5 and 15%. So I just think big cap tech, which led the market for so long, is dragging on the market, and that is going to continue in the months to come.
Remember, it was just a couple of months ago that the market seemed to get comfortable with the idea of a soft landing. What do you see ahead for this economy now? And again, what do you think the Fed is going to say in their next meeting, a big meeting coming up, and then that big confab of central bankers getting together here, the Jackson Hole meeting as well? And what do you think is going to come of all that?
Well, look, Frank, the whole point of my book, Price is Primary, is that you really want to watch the price. I mean, that leads the news. And if you look at price now, what you're seeing is extreme weakness in a lot of risk assets. It's not just stocks. I mean, even Bitcoin has been breaking down as of late. Higher rates and lower risk assets. And, there is some fundamental justification for that as well. I mean, interesting stat out earlier today that severe delinquency for auto loans, people's loans on their cars, it's at its highest level now since at least 2006. So people, despite supposedly a very good job market, people are having difficulty even making their auto loans. So, I think there's a lot of trouble brewing under the surface, as I said. So, one of the few areas I am looking at in terms of markets is actually some of the pharmaceuticals. Eli Lilly, I think you can buy here, LLY. But I think you got to keep a lot of liquidity, Frank. As I said, higher interest rates are shaking the entire financial services, the entire markets writ large, and you're going to want to have plenty of dry powder on hand in the weeks to come.
You're live with Jonathan Hoenig, and you do a great job tracking all of this, Jonathan. So let me ask you at this point, I know you've had a chance to think about this ahead of our time on the air this morning. Any specific places where you are putting money now and or taking it off the table?
I think you actually can put money to work are shipping. I mean, they've been on an amazing roller coaster in recent weeks, but assets like, for example, Ship Financial, SFL, or STNG, which is Scorpio Tankers, or DHT Shipping, these are all relatively small caps, high dividend players that tend to be non-correlated with the rest of the market. So I think shipping stocks are one place you can make money and hide out when the rest of the market seems to sag under the weight of these still very expensive big cap tech stocks. I mean, NVIDIA is obviously in focus, Frank. Earnings out after the bell on Wednesday, trading at northward of 50 times earnings and still up 200% year to date. So a lot of expectations for great performance from stocks that have already had hell of a moves year to date.
Right, we have another crisis brewing that could affect the price of oil with an oil tanker seized off the coast of Texas that for months had been suspected of carrying Iranian oil offloaded just days after some lawmakers wrote a letter to the White House questioning the delay. Might this lead to another crisis here, Jonathan? And what do you see ahead for the price of oil now hovering at around $81 a barrel?
Well, energy was the only sector that made money during the 1970s consistently, Frank. So I do like oil longer term here. Murphy Oil, MUR, is one I think you can own here. But in terms of commodities, in fact, one of the hottest commodities now in terms of is no stranger to crisis. It's not oil, it's actually uranium. And there's a whole subset of uranium-linked ETFs, Frank, names like NLR or URN or URA. I think as one part of a portfolio, a truly diversified portfolio, if you want to find the hottest commodity, it's uranium right now. And certainly a lot of political, environmental elements to do with uranium. It's closely linked, of course, to nuclear and nuclear production. So take a look at some of those uranium-related stocks. And CCJ is Camco, the big uranium producer, also breaking out right here. I think you're going to hear a lot more about them in the weeks to come as higher uranium prices and higher price for uranium stocks.
On there live with Jonathan HOENIG, and you're right about the cryptos. Mudslide appeared to have hit.
Introducing Rich Valdez, America at Night, the podcast.
Welcome to the conversation, familia.
A perfect blend of news and entertainment, interviews and insights.
It's really just an expose on how messed up things are.
America's nighttime town hall whenever you want.
It's a huge problem that deserves a lot more attention.
Rich Valdez, America at Night. Follow the podcast wherever you listen.
Bitcoin over the weekend here, Jonathan, with Bitcoin now hovering at just above 26,000. It popped above 30K not too long ago, back to around, 26,125 here. What are your thoughts about how the cryptos have held up in the face of these higher bond yields and everything else that's going on?
And interestingly, Frank, even a report that Elon Musk was supposedly planning on introducing Dogecoin as a payment in the Twitter, or I should say X, ecosystem now hasn't. This is unfortunately is just wilted under the weight of exactly as you said, lower prices for technology writ large, higher bond yields across the board, and crypto had been holding in there quite well. In fact, for most of 2023, it's wilted in recent weeks, and I don't think you buy this dip. I think you have to wait and see. As I said, the changes in interest rates are still yet to filter through the rest of the economy. And I think people, were happy to own crypto when interest rates were zero and crypto was soaring. Now crypto was wilting, and you can get 5.5 just sitting in the bank. That's going to change the trajectory for a lot of these crypto assets in the weeks to come.
Given what's happened here in Southern California over the weekend, and of course, nervous time back east with the Atlantic hurricane season getting active now, would you be avoiding the insurance names or anything else that we can learn from, given what's happened recently?
Sure. Yeah. I mean, insurance isn't on my list, but actually one risk-related name I think you can take a look at, Frank, and that is the CBOE. This is the major securities exchange that specializes in risk transfer. That is the options market. CBOE dominates that. It's been rumored as a takeover play for quite some time. And in fact, that's one area you could see some consolidation, Frank, is specifically in financial services. The exchanges are still pretty fragmented globally. So CBOE is the ticker symbol. It's also the name of the exchange. On my list over at capitalispig.com. And I think that's one area, if you're interested in risk and risk transfer, you could make some money in the coming days.
All right. What about the travel-related names, the cruise lines and the airlines, which certainly got a pop this year? Any thoughts about that sector here now?
I've watched it, and, Frank, we've all said it. And even as a professional, you say, coulda, shoulda, woulda. And I've, watched so many of these names like American Airlines and so many others just having incredible years, up 38% year to date for so many of these travel-related stocks. I mean, and even in the face of those higher travel costs, I should say, and higher
fuel costs
for energy, Frank. Yeah, fuel costs, exactly. They've continued to go up. And I don't think you chase that move, Frank, but I don't think you fight it either. I mean, the entire market's going to take a breather here, but I think, once it gets back on track, I do think that some of these names could power even higher. I mean, keep in mind, so much of investing is the waiting. It's the sitting and the patience to wait through those periods of time. So I think if you're sitting on gains with travel names, continue sitting on them and try to wait out what will be a short-term storm for stocks.
And before the storm, those videos about those smash and grab incidents here in Southern California were getting international attention, Jonathan HOENIG. And what about the retail names, which, of course, retail theft has taken such a big spotlight now and costing these big companies billions of dollars? What are your thoughts about the retailers and what's happening?
The one to own here, Frank, is the boring, tried and true, and that is Walmart. By far the strongest retailer. Also, really the best position when you come down to the integration of the physical footprint with the technological advancements. So, Walmart, it's not too far off from its 52-week high. It's knocking on that door of a long-term ceiling going back to at least 2021. So I think, stick with the tried and true, stick with the steady. Walmart, I think, is the name to own right now. And unfortunately, for those of us who live in cities, that reality of that street crime is going to continue. I mean, this is a reality of just going to be an expense for store owners, a terrible inconvenience for citizens of cities. But I think Walmart, WMT on the New York Stock Exchange, that's the retailer to own right now.
Jonathan HOENIG, Fox News contributor, portfolio manager at Capitalist Pig Hedge Fund, and author of the book Price is Primary, How to Profit with Any Asset in Any Market at Any Time. Jonathan, thank you very much for kicking off the new week here with us and for that excellent analysis as always. We do appreciate it. We'll be looking for you on Fox and hope to speak with you again here very, very soon. Thank you very much for taking the call.
Great pleasure, Frank. Be well. Have a good day.
Thank you. Thank you very much. Jonathan HOENIG, live with us here tonight. Folks, it is jarring to have a car accident out there and hard to think clearly when you're hit. So my friend, attorney Clark Fielding of Fielding Law, has created something to help you. It's a guide called Be Prepared Before a Motor Vehicle Accident. The guide is one page, fits right there in your glove compartment, gives you everything you need in case you're hurt in an accident. Go to clarkthesharklaw.com and download your free one-page guide. Keep it right there in the glove box and put Clark Fielding's number in your phone, too, under the word accident. So all you have to do is hit the number when you need him. Tell your family and friends to do the same. So if you're hurt in an accident, call the one we all trust, Clark Fielding. The number is 833-88-SHARK, 833-88-SHARK. That's 833-88-SHARK. And download the Be Prepared Before a Motor Vehicle Accident Guide at clarkthesharklaw.com. Get it now, clarkthesharklaw.com. Mottek on Money continues here in 790 KABC. Good evening. Mixed start to the new week on Wall Street with the Dow slipping at the bell today, down 37 to 34,464. The S&P 500 managed a closing gain of 30 points at 4,400, and the Nasdaq gained 207 points at 13,498. We see the yield on the 10-year note has shot higher to 4.34%. That's the highest we've seen since November 6th of 2007. Price of gold, meanwhile, moving a bit higher, up 70 cents at $1,923.70 an ounce. Crude oil up 11 cents at $80.83 a barrel. Southern California gas prices continue to soar, and it looks like the storm situation did not help the price situation here in Southern California as prices continue to tick higher through the weekend in the face of the remnants of Hurricane Hillary, which barreled through the Southern California area over the weekend. Taking a look at those gas prices now here in L.A., we see a $5.35, the average price for regular, $5.68 now, the average price for premium, and $5.81 now, the average price for premium, higher across the board. Taking a look at the Cryptos now, we see a Bitcoin up about $10 at 26,125. Yep, you heard me. 26,125. Bitcoin taking a hit over the weekend. Ethereum down 5 at 1,667. And Doge here at 6 cents. Some of the other names in the spotlight, we did see Goldman Sachs shares down by about 1%. Johnson & Johnson in the spotlight today, down about 3% after the company said that its $35 billion exchange offer for Kenvue that expired last Friday was substantially oversubscribed. Also, we're watching shares of Tesla moving higher today by about 7% after an analyst at Baird highlighted positive developments for the EV maker in the second half. And shares of Palo Alto Networks up about 15% after the cybersecurity company's earnings report on Friday topped analyst expectations. Mottek Money continues here in 790 KBC. Another fiscal cliff approaching in Washington. Nervous time over the interest rates. I just talked to Jonathan HOENIG about mortgage rates ticking higher. Fed's next move, inflation ticking higher as well. That Fed meeting's coming up fast. On the economy tonight, let's bring in Paul WINFREE now, the president and CEO of the Economic Policy Innovation Center, EPIC for America, a new economic think tank. Paul WINFREE is former economic policy advisor and former White House director of budget policy under President Trump. Paul WINFREE, thank you very much for coming to the line here. And given the dramatic bond moves we've seen lately, give us your assessment of things here at the moment. What's happening?
Thanks so much for having me on the program tonight. Look, I think that there are a lot of great underlying things with the economy right now. But at the same time, I mean, you just mentioned the bond market. Productivity over the last couple of years has been falling. GDP growth has honestly been too low and probably too juiced by government spending over the last couple of years. And there is much more that can be done and should be done by Congress over the next couple of years and hopefully by a future president.
Appreciate that assessment. And then we have those downgrades of the banks and downgrade of Uncle Sam's credit rating, downgrade also of the mortgage giants, Fannie and Freddie. Haven't seen anything like this since the financial crisis days. What's really going on behind the scenes?
Well, I think that, those folks, I mean, they have to answer to the private sector, right? They have to answer to the bond markets and folks who are willing to give the government money. And what they're doing is they're looking not just at the political situation and the fact that our policymakers just jump from fiscal cliff to fiscal cliff without really considering, A, how to get the debt under control, but B, how to effectively do their jobs. And then the second thing that they're looking at is the long-term and medium-term fiscal scenario. So you mentioned it here at the top of the segment, which is that in 2025 there's a massive fiscal cliff coming. The last major fiscal cliff that the government had to deal with, orchestrated by themselves, was in 2012 and 2013 with the expiration of the Bush tax cuts. At the end of 2025, we'll have the expiration of about half of the Trump tax cuts. That's all of the individual tax cuts. And then also a lot of the good things that the 2017 tax bill did for businesses, like depreciation and a number of other things. At the same time, there were a number of items that the Democrats implemented at the beginning in the middle of the COVID pandemic to extend health insurance, to extend other subsidies to state and local governments. All of those things are also expiring at the end of 2025, as well as the debt limit and fiscal bill that McCarthy and Biden just agreed to that suspends the debt limit through the beginning of 2025 and also sets the 2-year spending agreement for discretionary programs under the federal government. And so when you add all that up, it's about a $3.5 to $4 trillion fiscal cliff. And in my view, if Congress and the president don't get serious about that now over the next 12 to 24 months, then they'll just kick the can, which is what D.C. is good at doing, right? It's good at basically kicking the can until they are forced to do something, which hopefully they will be given the downgrade by the ratings agencies.
Right. So a lot of people just kind of sloughed that off. But the fact that happened, how significant is it, and how serious is it, and what signal does that send, and will that message be heard in Washington?
Well, I mean, we're seeing it right now, just in the payments, the price of debt that the government has to pay in order to take on more debt, right? So the price of debt, those 10-year Treasury rates went up virtually overnight after being downgraded. The reality is that if you look at the historical price of debt, it's been falling over a long period of time. It has jumped in a couple of different periods over the last, say, 40 years or so when we've had instances like this. I mean, you mentioned the 2008, 2009 financial crisis. But the reality is the Congress and the president are not getting serious about the major drivers of the debt, in particular, healthcare costs, right? This was something that used to have a bipartisan consensus. Everybody knew that healthcare costs were ultimately driving the debt. Now, nobody, right? There's no bipartisan consensus on this, and that's what the ratings agencies are starting to pick up. I ultimately think that policymakers will respond to that higher price of debt. I just don't know whether or not it will be at 4% interest rates or 5% interest rates, or whether or not they'll have to go up to 8%. But the problem with that, as you know, and folks who operate in the finance world know, is that when the government has to pay those high rates, that also means that we have to pay those high rates, right? And that means that there's less money that will be available to buy a car and take out a mortgage and start a new business and all of the things that people like to do with credit. And that's a major, major problem, and hopefully will begin to provoke some discussions about getting serious on the federal debt.
On your live with Paul WINFREE, and you've taken on the job of trying to educate lawmakers, right? Given your experience in government, and now you've created this new think tank, the Economic Policy Innovation Center, EPIC for short, right? Tell us about what you're doing and what you hope to accomplish there.
Right. So I think that my model of the legislative success sequence is first you got to get the education right, then you got to get the policy right, and then you got to get the politics right. The reality, if you look at the makeup of Congress right now, the median member of the House of Representatives was not in Congress when Paul Ryan was the Speaker of the House and when Trump was president. That was not that long ago. And the reality is that when you have that kind of turnover, you need to be able to give the members of Congress in particular the tools that they need, not to just do their jobs, but to be able to understand these complex issues like our federal fiscal situation much better, so that they can better represent us in Washington, D.C. And so we're spending a lot of time on that over the next year, but we're also spending a lot of time talking to all of the presidential candidates, with the exception of a couple, including the guy who's currently in the White House, about what good economic policy looks like, just to make sure that their platforms are also in a good place as we go into 2024, so that we can build a pro-growth agenda in 2025 going forward. Because, as I mentioned earlier, and as the bond markets are trying to signal, look, we do have to get serious about these issues. Now is the time to put together a pro-growth agenda. And the first thing that we need to do as part of that is to start to get control of the federal debt and pull back that quite a bit, especially given the explosion, the $8 trillion in new debt that has come on to really most of it, the Federal Reserve's balance sheet, just since the beginning of the pandemic. So EPIC, economicpolicyforamerica.org is our website, and we're going to be spending a lot of time working with policymakers to make sure that they can better represent their constituents.
All right, while we have you on the line, we've got some big Fed meetings coming up, Jackson Hole, and then, of course, the next Fed policy meeting. How much higher are rates going to go, and what do you see ahead for inflation here?
I think that all signs point to the Fed having a hard time getting control of inflation. I mean, I wish that I had better news than that, but that seems to be where this is heading. It wouldn't surprise me if there's another rate hike. There might be another couple of rate hikes. I don't know if it'll last much longer than that. I suspect the number that I'm looking at and the number that the Fed economists tell me that they're also looking at is productivity. I mentioned a little bit earlier that if you look at over the last couple of years, productivity has fallen at about 2.2%. But if you look at productivity growth over the last year, it's actually increased by a little bit. that's a good thing, but it needs to increase by a lot more if real wages are going to keep coming up and if core inflation is going to remain high, at least above the Federal Reserve's target. So I think that more rate hikes are in our future, and that's all the more reason to start getting serious about fiscal policy as well, because if you reduce the deficit, you take pressure off of the Fed and their balance sheet, which is so it was exactly what they would celebrate and would be looking for Congress to do right now.
Paul, thanks very much for taking the call. Great to connect with you and look forward to getting your views from time to time. That is Paul WINFREE, the president and CEO of the Economic Policy Innovation Center, EPIC for America, a new economic think tank, former economic policy advisor and former White House director of budget policy under President Trump. Paul, thank you very much for taking the call with us here live tonight.
I appreciate it. Thank you so much.
Mottek and Money continues here in 790 KABC. Good evening. Coming off the first tropical storm to hit Southern California in 84 years, Hillary walloped Southern California over the weekend. We're hoping to talk to ABC 7 meteorologist Dallas Raines coming up here about what happened. He might have gotten busy, though, so let's see what happens. In the meantime, the once Category 4 hurricane Hillary hit Southern California hard with the historic rainfall we saw yesterday, flooding roads and knocking out power. A bunch of businesses along Melrose Avenue, for example, got flooded out, and a lot of flooding in many other areas. Sporadic street flooding. The whole Hollywood area was quite a mess yesterday. Rainfall totals from Hillary reached 13.5 inches in San Bernardino County and 11.7 inches in the mountains of Riverside County. L.A. County overall recorded more than 7 inches of rainfall. Yep, you heard me. Downtown L.A. recorded about 2.5 inches of rain on Sunday, making it the wettest August day ever, according to the National Weather Service. Palm Springs saw more than 3 inches, which broke the Desert City's all-time daily summer record. And San Diego saw nearly 2 inches of rain, making Sunday the wettest August day in that city's history, according to ABC News. Escondido also saw about 2.6 inches, marking the wettest month of August in that area. The Hollywood Reservoir went up nearly 5 inches over the weekend. Beverly Hills saw rainfall of nearly 5 inches. In Bel Air, they got about 4 inches of rain. Culver City, where we are here, nearly 4 inches. Santa Monica, about 3.5. In downtown Los Angeles, about 3 inches of rainfall. In Long Beach, nearly 3 inches. And LAX was walloped with about a 2.5-inch deluge. And Hawthorne saw about 2 inches of rain in Hurricane Hillary, the remnants of Hurricane Hillary anyway, dumping more than half the average annual rain on some desert and mountain areas, including Palm Springs, which saw nearly 3 inches of rain. Tens of thousands of people all across Southern California had no power due to the storm. Palm Springs lost 911 service last night, and the station, the reports that we're getting, Hillary's outskirts were still lingering over the Los Angeles area, battering some regions with heavy rain into this morning. Most areas have cleared away now here in this area. It's moved on now. In fact, it's moved on quite far into the country at this point, with northwest Arizona, much of Nevada, southwest Utah, eastern Oregon, western and central Idaho, and even southeast Washington feeling the effects of that storm. A flood watch was posted for some of those areas, if you can believe it. In Nevada, officials remain concerned about dangerous flooding across the western Mojave Desert, which was at risk for flash flooding. So that was quite a wallop here for Southern California. And we had the privilege of speaking to meteorologist Brian Norcross, one of the top hurricane and storm experts in the country, leading up to that big event, which turned out to be an epic meteorological event. And we thank Brian Norcross for coming to the line. And, of course, ABC 7 Eyewitness News meteorologist Dallas Raines does a fantastic job on ABC 7 Eyewitness News, and we'll hopefully have the chance to talk to him about it. He's been covering the weather here in Los Angeles since 1984, and looks like haven't seen anything like this since, going way back now. First tropical storm conditions recorded here in the Los Angeles area since 1939. Hillary, the first tropical storm to hit Southern California in 84 years. We did see people swept into swollen rivers, toppled trees into homes, and flooded roadways as that system marched right through this area, prompting flood watches and warnings in more than half a dozen states. We, of course, saw the storm hit Mexico hard, the Baja California Peninsula. Hillary was a hurricane when it hit that area, causing one death and widespread flooding before becoming a tropical storm and impacting this area. The winding roads in the San Bernardino Mountains were blocked by mud and debris flows, and Hollywood Hills also saw a lot of flooding. I was on Sunset Boulevard yesterday, and debris started flowing down from the hills onto the Sunset Strip, and a whole mattress and box spring setup ended up on Sunset Boulevard, washed down Larrabee, I believe it was. A stretch of the 110 freeway near Palm Springs also shut the traffic over the weekend because of pooling water in Palm Desert. They had a lot of incidents there. A big tree fell onto a condo in that area, and looks like there were some other incidents where trees were down throughout this region. A tropical storm last roared into California in September 1939, ripping apart train tracks at the time, tearing homes from their foundations and overturning boats. Nearly 100 people were killed, by the way, on land and at sea back in 1939 when we saw tropical storm conditions impact the area. Now the focus of attention as far as storms are concerned goes to the Caribbean. Tropical storm Franklin is near Haiti and the Dominican Republic at this point. Authorities warning residents there to prepare for flooding and landslides. Forecasters at the National Hurricane Center also watching a disturbance in the Gulf of Mexico that has now an 80% chance of developing into a tropical disturbance or tropical storm before reaching the western Gulf coastline on Tuesday. So once again, the oil production could be disrupted in the Gulf of Mexico because of that storm. And we are watching what's happening there. The cruise lines did quite well in all of this, sending the ships away from the storms, as is usually the case. So no incidents have been reported related to the cruise lines. Travel, of course, some of it was disrupted over the weekend with some flights being canceled because of the effects of Tropical Storm Hillary. It was somewhat of a stormy day on Wall Street, another volatile session with the Dow down 37 points at the close. We're back to 34,464. The S&P 500 moved up 30 at 4,400, and the NASDAQ gained 207 points today at 13,498. The big story once again in the financial markets, rising bond yields, which impact borrowing costs, among other things, and mortgage rates moving higher. The yield in the 10-year note now at 4.34%. We saw the average 30-year fixed-rate mortgage move above 7% last week. We'll be getting updates on that this week. Price of gold right now hovering at $19.23 an ounce, and oil just below $81 a barrel. This is Mottek on Money. I'll be back again tomorrow evening in the 5 o'clock hour for you. You can also bring up the Mottek on Money podcast on demand at KBC.com. This is Mottek on Money on 790 KBC.